So good morning, good morning still, everyone. It's my pleasure to introduce a panel which will focus on evaluating investments. We have around me 4 specialists who probably accumulate several decades of investment experience in the restaurant industry. We'll talk about various types of investment and how their evaluation differs. And I think I would like to kick off this discussion with Martin Sherwood, who has many years of experience taking projects from cradle to the next stage, or using various boosters for the financing as well through tax incentives. And so maybe, Martin, you want to say a few words, what do you look for when you review a new project, a startup?
So what we look for, so it's a very long list, sort of 20 to 30 questions, but the number one thing that I always look for is the track record of the management. So a manager or an entrepreneur approaches us, wants to raise money for a new concept. The first thing we ask is, what has that person done before? What is their track record? Have they made money for investors before? Have they lost money? If they did lose money, what were the reasons? What were the excuses? So I think the track record is absolutely the number one thing we look for. Number 2 would be the valuation that entrepreneur is placing on his business. So he wants to raise £2 million, representing what percent of the equity of the business. So usually these entrepreneurs, they overvalue their businesses. So it's usually a bit of horse trading has to go on between us and the entrepreneur to bring the valuation down to a realistic valuation. Thirdly, how much money has the entrepreneur put into the business himself or herself? What is the commitment, both in terms of money and also in terms of time spent on developing the concept? Fourthly, how reasonable are the financial projections? Almost invariably, you're given a 3 to 5 year plan with sales that kind of go up in that direction. Well, we all know that reality is a little different from that, and sales tend to go up in slightly lower angle. So you've got to look at projections with a very realistic open eye. And fifthly, before I let somebody else speak, my particular speciality is tax incentives. And in the UK, we have a very brilliant scheme, which is called the Enterprise Investment Scheme. So almost all the investment we do qualifies for that scheme. That means the investors get a discount of 30% on the tax. They pay income tax relief, and that makes it, of course, a lot more attractive. So already your net cost is only 70% of what you're actually putting in. So those are the 5 big ones, and there are plenty of others.
Thank you, Martin. Jonathan, now speaking of track record, you have quite an impressive track record. You have opened over 20 bars, clubs, restaurants, and a hotel, and not only in London, but also in Ibiza, in Chamonix, in Melbourne. Yep. So you must do something right, I'm sure. Maybe you've now put on the hat of investor, and you are actually looking for investment projects through London Union. Yep. Can you share with us how you've used that experience in order to screen those projects you want to put your money and your investors' money in?
Yeah, I mean, a lot of the new business ideas I see are, they don't have a track record. It's often people moving into a new career. But if I like the individual and they seem committed and sensible, if they've got a strong concept, also that's very important. I like people who are doing things that aren't too complicated. In street food, you tend to get people who focus on one thing, whether it's guava bao or burgers or tacos, and they just do it really well. I also like to focus on concepts that have got longevity. I think there's a lot of sort of trendy, flash in the pan sort of stuff. I don't see, I mean, everyone's jumping on bubble waffles at the moment in London for some reason, and I can't see them being around for much longer. Anyone building a huge business around bubble waffles in London, maybe I'm wrong. And almost every week we're seeing something really good that ticks all those boxes. And there's a lot of exciting new businesses that are starting out with street food and then testing their concept, developing their concept, getting feedback from their customers, sort of fine-tuning their menu and their offer, and ready for the next step into restaurants. And so it's a really good time to be involved in that.
Okay. What would be the typical ticket of the projects you're working on?
Well, a lot of the businesses that we're investing in they've got a low capex. So, for instance, our new site in Canary Wharf, which opens in about 2 hours, we have spent £30,000 investing in Yum Bun's space there. So it's not a huge amount of money. We're a 25% shareholder in Yum Bun, and if Lisa, who's the owner of that business, wants to do standalone restaurants, then we're in for whatever she wants to do that makes sense. So it's not a huge risk for us. It's low capex, it's fast return investments for us.
And your portfolio of projects at the moment, how many?
We've got about 6 on the go at the moment, yeah. 6 live ones.
Okay. Now, if I turn to my left, and Paul, you represent more the next stage, yes? And you've taken some larger businesses to become yet larger. You've made some very significant investments for large private equity funds. So what would be the criteria you use when you are evaluating the next phase of growth, say, to move ahead and move beyond the 20 restaurants we were talking about yesterday?
Yeah, so the situation when you've got a larger group, obviously, you've got a track record. And everything is about the credibility of the plan that somebody's putting forward. So this is a rollout plan. You're going from 20 to maybe 50 sites. And people don't look at, or quite often we see people not really reflecting on the fact that the track record will tell everybody what is likely to happen. You've got a consistency, hopefully, of opening sites. How long does it take to get to maturity? And therefore, what is likely to happen? But when you've got to 20, you've got some private equity investment probably already to get to 20. You're therefore stepping into a second round of funding. And I think it's a more grown-up phase. You're getting a lot of money coming in. You've got a high valuation. You're taking some cash probably off the table. And so for the individuals concerned, it's a new phase. And I think plans and the credibility of a rollout, often what we see is people are trying to go too fast. Their plan says we're going to move in 3 years from 20 to 50 restaurants, and that's just not possible. So I think the advice generally that we would say is don't move too quickly in that phase. And private equity, I think, is now much more accommodating of that fact. An interesting part that I think came up yesterday was the fact that people are now asking the question of, do you own the customer? And that all comes around because of home delivery. And home delivery in the UK, as around the world, is a growing market. But what they're asking is, do you own the customer? Because if they go to Deliveroo or to one of the other options and they're buying their burger or their whatever it happens to be, you don't own the customer. And financiers now are looking at it and going, that's a problem. Because you come off Deliveroo and they'll still buy the burger through Deliveroo from somebody else. So in the financing side of it, again, that is a very important factor and one that people are now having to wrestle with. And I think it's looking at the history of what happened with the hotels and the parties that took over the customer. This is now happening in restaurants, and I think it is reflecting on the pricing that people have.
Thank you. Mohamed, you are based in Dubai with Ento Capital, and can you share with us your perspective from a more regional investor's perspective? So when you look at projects, what are you looking for? Franchises, own brands? what size of projects are you looking at? Can you share with us a little bit your experience and your insights?
The region itself is a very niche region, right? So you need to look at the concept on whether it makes regional sense and if it coincides with the political, the economic, the social, and the cultural aspects of the region. So looking at an investment from the feasibility side is the first thing we look at, of course. And then you have the management team. So the management team really needs to have a track record, that's for sure. But then you have to look on whether the management themselves has a business sense or just a F&B on the ground operational expertise. So you need that vision, you need that passion, the inspiration, and the long-term expansion plan. So in order to have that, then you need to have dedicated deal makers on the ground in the region that can benefit the bottom line of that business. So it might be a successful business, the way it is right now, run by a family business or a family enterprise, but you need the business sense on the back end. So then you look at the financial aspects. The truth in our line of work is usually audited, so you look at these things, but really the roots come down to the management team and whether the concept itself makes regional sense and whether it fits with the culture at hand. The majority of the culture is a Sharia-oriented business model, right? So we only do Sharia investments and Islamic financing. So that's a big thing when we're looking at international brands coming into the region. So there's a bigger appetite on homegrown brands lately, also due to the fact that you don't have to report on an international level, meet brand guidelines and all the other things. You have more flexibility. So if you can build the flexibility with the international brands that are coming into the region to accommodate to the culture, then there's a good potential for these international brands to come in. But when we look at an investment firsthand, it's really the management team and whether it makes regional sense. The investment sizes are between, from a fund level, it's 5 to 10 million per transaction, US dollars. From a direct investment perspective, our mandates are between 10 to $100 million.
Okay. Now, international expansion, that's the other big difficulty, yes, and challenge in this business. So how do you see, what would you say to a European restaurant group which is looking at international expansion? Where to go? China, the Gulf, US, Russia?
I think it's an interesting challenge when the European businesses are looking at where do you go. And whilst franchising is an income stream and it's relatively, as long as you get the right franchisee, it works. The value that you create in doing that is limited. You know, you get your income stream, but you don't own the business. So a lot of people have been looking at where to go, and I suppose the panacea is going into the US because it's such a huge market, and the valuations that you get if you go into the US are stratospheric. But the difficulties are huge, and you know, Alix Partners has an operating team, and they have worked with the likes of Nando's when they went into the US. And initially, Nando's didn't work in the US, and so it took time to build it. You go into Washington, you build around that, and you go to Washington because it's got various different demographics, so you can prove your concept, and then you move on to other American cities. But for European businesses, going into the US is littered with disasters that have happened, and very few have been very successful. But the driver really comes around, if you can get to enough scale in the US, then your valuation will be very, very different. So for Wagamama, the advice coming to them was, if you can get to 25% of your portfolio being in the US, then you can float in the US and on the US stock exchange, and you can maybe get to your Shake Shack sort of valuations because people will see the opportunity to go to 500 sites in the US or more. So that is really where people are looking. But if I look at what's actually happened to UK, especially businesses going in there, I would say that very few of them have actually hit that. I mean, Pret is doing quite well, but it's a very, very tough market.
So your piece of advice for a group which wants to expand in the US, what should they focus when they come to see you? What should they have ready?
I think it's very important that you really do your homework and you get advice around how to do it. I think going in, if you're going to be opening them yourselves, and you look at Wagamama, they went to Boston, now they're in New York, but that's taken them 7 years to get to about 5 sites. The Nando's piece, they were there, they had about, again, 5 sites. Then they took sensible advice. They built the plan and said, we're going to do Washington, we're going to learn from that, and then we're going to grow. And now their biggest selling site is in Chicago, as globally. And I think as long as you've got the plan and you're building it. In the UK, we've seen people like Yo Sushi, we've seen Carluccio's go in there, and they toy with it. And I don't think you can toy with going into the US. It's just it'll drain the money. So if you're going to go in, really put the money aside, put the time aside, find the right people, and the opportunity is huge.
Okay, thank you. Any more comments, Jonathan, on international expansion? And
not especially. I mean, a lot of the businesses we're looking at, it's very early days for them. I mean, they're still at 1, 2, 3 sites, really. I mean, London Union, we're looking to go into the US next year, and I'll be taking a lot of advice from Paul and his team before we do that, as well as 1 or 2 colleagues in the industry who are having a go. I know the guys from Hawksmoor are planning to go there, and they're great people to talk to. I'm really excited to try and expand in the US. It's a really challenging market with some incredible brands there, but I think what we're doing is different to what exists there, so I feel quite confident we can do well.
Mm-hmm. Thank you.
I mean, I think it's interesting that we just, from a UK point of view, we've just seen a business called Brewdog get a valuation of 100 times income from a private equity house. It's a crowd-funded business, and obviously that's what Jonathan's after, 100 times multiple. But that is the sort of valuation you can get, and that's because they like the brand, the beer brand, and they see what Fever Tree has done and businesses like that. The fact it runs bars is slightly, I think, irrelevant to the valuation metric, but that's the opportunity I think people are looking at.
Right. Any questions from our audience? Yes.
Why are you expanding to the US first? I mean, if you're in the UK, wouldn't you go, around your neighborhood because you have better control over it?
Yeah, good question. We've looked at Amsterdam, Berlin. We're looking at something in Paris at the moment. But we've got a big side of our business is digital. And I don't know if you were here yesterday when I showed the little Chin Chin Labs film. And we see a lot of value in that side of our business. And if we want to grow the digital side of our business, which is working with drinks and other brands to promote and create a revenue stream, then we really need to go into the digital space that is North America. Plus, we've got a lot of on-the-ground support from Soho House Group. We're looking at LA, Chicago, New York, and Miami, because those are the 4 cities that Soho House Group are in. And so we'll have some good operational support there, we feel. But it's really about, I know Miami quite well, I know LA quite well, I know New York very well. It's been I've never spent any time I never lived in Amsterdam or Berlin. I've visited a lot. But I think it's really understanding those markets better than perhaps markets that are closer in Europe.
Mm-hmm. Some other questions? Yep.
Thank you. This is maybe more directed to Martin and Mohamed. We've seen a lot of funding, in the area, and especially they were booming in the last 6 to 5 years, in the Middle East. And we've been fortunate enough to being approached by a lot of investors and a lot of funding in the area. And we came to a point where, I mean, if you look at Beirut alone, the funding capital in Beirut from seed ventures to venture capitals, etc. If you just, Beirut alone, which is 4 million people, we have a basket of available funds of more than $300 million. And I was researching once on Google, and the whole Google venture fund is $200 million. So there's a lot of money, there's a lot of investors coming up in the region, but the transactions are just not happening, because what we're seeing is that senior fund managers are not always here, and junior fund managers, this is why, I mean, you both guys look handsome. I mean, Mohamed and Martin, there's no difference, but I'm not pointing at you. But what we've noticed is that there is still a lot of, if you want, how to evaluate the company, and there is still a gap between people who need the money and people who have the money. How do you see this evolving in the region? I mean, how do you see this culture happening more like in the United States, for example?
Thank you.
Go ahead.
I think it's a question for you, really.
Yeah.
It's true, there is a huge gap in the funding gap in the region, which is why venture capital and private equity fills that gap, especially that it also falls under a Sharia guideline, right? It's hard to go to a bank, as a Canadian, for example, in Canada, if I have a project, I get my 100K from the bank on my own name and start my own business and pop-up shops. And it's not that easy to do that here on your credit, right? So venture capital and private equity fills that gap. The problem is not the cash. Cash is no longer king. Access is king. So access to the right deal flow is lacking, right? So these companies that you speak of need to be nurtured for at least 2 years by advisors or investment bankers before you can actually hit the valuation you want to actually sell it or sell a stake or raise the capital. So the problem is not in the juniors and the seniors that are traveling all the time, but the problem is in managing advisor and client relationship and trying to educate the client to a point where patience is necessary in order to nurture your deal, have the proper documentation, work on it from a regulatory point of view so that you build the investor confidence. So as a DIFC-based investment bank regulated by the DFSA, you're approaching clients or investors with a regulated deal that is structured, you understand? So you build that investor confidence. Most restaurant owners that I deal with, and currently we have 4 live transactions, it's very hard to educate them on the fact that there's a process that needs to take place. The money's not in my pocket. I can't just get it out and give it to you, right? So it's really that, to that level, it's a relationship level which makes these deals not go through. And the transparency in the region is also something that is underestimated by entrepreneurs, but really appreciated by investors. So whether your business is in loss or not, if you have a scalable model, interesting concept, that could be eventually disruptive, you'll reach a deal breaker, right? Whether you are profitable in the first 3 years or not, but be transparent about it. I don't want to go into due diligence process and then all of a sudden I found some very interesting things. Regionally, that's what we've been experiencing on a deal level. So the problem's not with the cash, the money's there. It's just the deals are not.
Yeah,
So
what I would say is I've dealt with wealthy people, investors for years and years, and parting wealthy people from their money is a tough job. They're very, very keen to hang on to it, and they're reluctant to invest in something that might lose money very quickly. So that's back to where we started, which is if you have a solid concept, solid management, a business that people understand, investors then gain confidence. They walk into the first unit of a new concept, say, and they immediately like it, and then they invest more money. So I think it's very much a question of I call it touching and feeling. So wealthy investors, certainly where I come from, they want to be all over their investments. They want to visit them. They want to say, I invested in this. They want to touch it and feel it. They want to know exactly where their money is going. So it's very hands-on, I think, wealthy people in many cases. If it's not them directly, then their wealth managers are very hands-on people and they're very cautious. So it's all about having confidence in the concept.
And what kind of success rate, what kind of percentage of the projects you look at, you come to a successful conclusion?
Well, we do a lot of funding of central London bar restaurants, and it's a series of concepts that come and go, and they take about 5 years to mature, and then they're sold on to a secondary buyer. So these are businesses that are built up not to be retained, they're built up to be sold. And I think it's a very brilliant concept. The idea is that in this industry, fashion is everything. New ideas come and go very quickly. A 5-year-old concept is quite possibly can be rolled out for many years, but quite possibly is going to be replaced by something else. So our philosophy is to sell the businesses on after about 5 years, and the buyer is usually a financial institution, private equity fund, who is buying a business that has maybe between 5 and 10 units with a view to rolling it out to 30 to 50 units. So they see a long-term future in the brand. So we're selling it, we're getting out, and it's their responsibility from then onwards.
Thank you. Any more questions? So maybe as a last question for you, Paul, what is the single, if you had to point at a single factor which makes project fail to complete when looking for investors? What is that?
I think the single biggest issue is people who try and do the deal themselves without involving somebody who does this for their day job. And the reason you do that, it seems simple. You're going to go out and get some money. You heard Stuart yesterday go, we weren't ready to go through a private equity transaction. And in that case, I think a lot of it was, what am I actually letting myself in for? And is Gordon Ramsay actually going to sign up to the sort of clauses that a private equity house will require? And somebody hadn't taken them through what that really means and put the business plan together. So, echoing what Mohamed was saying, I think it's very true that there's money out there. There's a lot of money out there that loves this industry because people can make a lot of money in rolling out these concepts. But you need to be prepared, and you need to have somebody take you through what it really means to go through that process, because in the same way I couldn't run a restaurant because I haven't got the skills and passion that a lot of the people have and the ideas. They're not ready for what's going to come with the private equity interrogation. And I think, exactly what you're saying.
That was very well said. The only thing I might add to it is again, the concept of transparency. You reach a certain level at a deal, and then you find out things, again, like the deal that he discussed about Stuart coming to a point where he didn't know what the terms were. So you need to just be prepared. And I agree with everything he just said.
Thank you. Thank you very much. Thank you all. So I think that's the end of our panel discussion.